Rick, first of all, on the payrolls report, sir, I would love your take. Then we can move along to the bond market, please.
Sure. Thanks, Jonathan. So I'd say a couple of things. One, it was a bit softer than expected, but I think you think about what the bond market is doing and what it's done the last few reports. The numbers have been weaker, but when you actually dig in and think about why they're softer, leisure and hospitality, no surprise, people aren't going to restaurants and the hiring can't take place there. So that is still disappointing. But when you go deeper into the report and you see things like the average work week extending, if you see things like temporary hiring growing, you see things like business services growing, what's happening is clearly you're building this dynamic where companies are trying to extend the work week a bit more. Companies are hiring temporary workers. The employment rate at the end of the year, I mean, this is something that is hugely important. We're going to get into the fours in the unemployment rate by the end of the year. So we are going to see, and when you talk about vaccine coming in and creating herd immunity, you're going to see last month we lost over 500,000 jobs to leisure and hospitality. That'll start coming back in, and then you'll see this pretty significant jump in employment. And that's where we're going. And that's why the Fed, I think as you get into the second quarter, the Fed's going to have to evolve the communication.
Rick, we're in such a unique moment. As you've just spelled out quite clearly, unemployment's coming down and the stimulus effort is ramping up. How powerful is that going to be? What's the best way of understanding this?
So, John, I keep going back to this one point, and I just think it's simple economics. This concept that we studied in economics, MV equals PQ. When you increase the amount of the money supply, the M, you increase the amount of liquidity in the system, you increase the monetary base. Then you put stimulus in. You are functionally creating this incredible influence on the economy. And so now, where does it come out the other side? PQ, prices times quantity. And I think what many people are saying, which I don't agree with, is it's going to show up in prices. And actually, I think that one of your guests on earlier was talking about this. When you look at companies and you look at their business and pricing power, I think more is going to come in quantity. So I think you're going to see growth continue to surprise people to the upside. You're seeing it in earnings today. You're going to see it, I think, going forward. And I just think, by the way, I do think inflation's moving moderately higher, but I don't think it's as scary as people would suggest. I think real growth is I think we're going to hit a 7% GDP, real GDP this year.
Wow.
That's pretty powerful after where we were.
That's the analysis. What's the capital allocation decision in the Treasury market that goes along with that, Rick?
Less of those.
Yeah.
John, I know we've talked about on the show the last few months. So I know there are, the Fed real rates haven't moved that much because what's happened is inflation has moved higher. Listen, I think we've talked about on your show, we think the 10 years going to 1.25. But I think as you start to see the acceleration, maybe we do press a bit higher in the 10-year. Maybe we do go to 150. And by the way, the one thing I will say, Mohammed has got some brilliant reads on a bunch of these things. I still don't think that that's an interest rate that is terribly devastating for companies or the economy. And I think he was right and said it didn't have much of an impact on the economy. But the one thing that I think we got to keep in mind, companies are financing still today. You're seeing financing, particularly in the front end of the yield curve, at 30, 40, 50, 60 basis points. That is incredible. So companies' ability to borrow and do M&A, do CapEx, do R&D is pretty darn powerful. I said direct injection of value into these companies, and that's why the equity market will continue to appreciate that.
Rick, I'd go one step further on borrowing costs. They've termed out this debt so much. The average maturity is so much longer than it was that even if rates go up, they're not going to feel it for quite a while.
Yes, sir.
So credit versus equity right now, Rick, which one?
Oh, equity all day.
All day.
I think all day. So there is, I think high quality credit, for buying investment grade credit at 40 basis, 50 basis, or even go out the curve and it's low 1%, or even it's like not interesting. Earnings yields at 4%, free cash flow yields at 4%. That is really interesting. I know people talk about PE ratio, but gosh, these earnings numbers. I think the earnings so far, we've got 53% of the companies are reported. I think the average beat is 14%. The average revenue beat, I think 80% of the companies have reported beaten expectations on revenue, and I think higher than that on earnings. Those numbers are pretty impactful. And like you say, interest costs, their borrowing costs, which can really impact margins, are going to stay muted for a period of time.
Is there a U.S. bias to that equity allocation, Rick?
There is. Yeah, we've actually reduced some Japan. We had some because we've been believers in a cyclical dynamic. Japan's done pretty well. We've reduced some of that. But yeah, the bias is, tactically in parts of Europe, some of the banks I think are interesting. We talked about on your show for the last couple of months at price to books at such low levels. But yeah, I still think technology, cyclicals, consumer durables alongside of a good economy. I think it's hard to argue. By the way, parts of China as well in technology are also quite interesting.